Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nike.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Because today we're looking at a situation that requires us to just completely separate the terrifying headlines from the actual financial reality.
Yeah, exactly.
Yeah.
I mean, imagine for a second that you're walking onto a car dealership lot, right? And you see this pristine, top-of-the-line Skirts car sitting there, but the sticker price has been slashed by like 50%.
Right. Your first instinct is probably, what's wrong with the engine?
Yeah.
Has it been flooded?
Exactly. But what if the engine is totally fine and the car is only marked down because, the dealership manager is personally panicking to meet some rigid end-of-month quota?
Which is such a wild scenario to think about.
It is, but that dynamic, a perfectly functional asset priced as if it's entirely broken, that is exactly what we are seeing today with one of the most recognized apparel brands on the planet. Yeah, the stock just suffered this brutal post-earnings sell-off. I mean, it is currently sitting at 9-year lows.
9 years. But if you actually lift the hood, there is this massive structural turnaround quietly taking shape. So our goal today is to help you figure out if this is just a value trap designed to separate you from your money or a generational buying opportunity.
And to answer that, we really have to temporarily ignore the stock chart.
Really? Because the chart is pretty ugly right now.
Oh, it's screaming panic. But the chart is just a reflection of immediate market psychology, right? It's emotion. If we want to know what the business is actually worth, we have to look at the fiscal Q3 2026 fundamental results.
Okay, so what is the actual reality there?
Well, the most critical data point in that entire report is that their core market, North America, is officially back to growth.
Wait, let's pause right there, because we need to emphasize how big of a deal that actually is. We aren't just talking about a brief dip.
No, not at all.
This is the first time in 8 quarters that North American sales have trended positively.
I mean, that is 2 full years of a massive global powerhouse essentially stalling out in its own backyard.
Yeah.
So how does a machine that big stall for 2 years? And more importantly, how do they finally restart it?
Well, this stall was entirely self-inflicted. I mean, to understand the recovery, you have to understand the sheer hubris of the previous management's strategy.
The whole direct-to-consumer thing.
Exactly.
Yeah.
Over the last few years, the boardroom became completely obsessed with the direct-to-consumer model, or DTC. And, the logic made total sense on a spreadsheet.
Sure, cut out the middleman.
Right. They believed their brand was so undeniably powerful that they just didn't need traditional wholesale partners anymore. They thought, why share our profits? We'll just force everyone to buy directly through our own app or our website or our flagship stores.
And keep 100% of the retail margin.
Exactly.
Which, is a beautiful theory until you introduce it to actual human behavior.
Right, because humans are lazy.
Yeah, what actually happens is that the casual shopper walks into a local mall, they go into a Foot Locker or a Dick's Sporting Goods to buy shoes for their kid, and your brand just isn't on the wall anymore.
Exactly. The consumer doesn't pull out their phone to download your specific app right there in the aisle. They just look one shelf over and buy a competitor's shoe.
Yeah. You essentially just surrender your physical real estate.
And that is precisely how competitors managed to sneak in and steal massive amounts of market share over those 2 years. The brand literally made themselves harder to buy.
Wow.
So that restart you mentioned, the return to growth this quarter, that is the direct result of CEO Elliott Hill's new strategy. They're calling it the sport offense.
Right, the pivot.
Yeah, it's an aggressive pivot away from that rigid DTC obsession. They are actively repairing relationships with those massive wholesale partners like DSW and Dick.
Using their physical footprint.
Exactly. They're using those partners' massive logistical footprints to just flood the physical market again, move high volumes of product efficiently, and brutally reclaim that lost shelf space.
And, I mean, the fundamental numbers prove the strategy is actually working. The financial results honestly blew my mind, especially given the current macroeconomic environment.
Oh, the beat was huge.
Yeah, we are looking at an earnings positive surprise where they beat consensus estimates by over 20%.
Right.
Top-line revenue came in at $11.3 billion, which also beat expectations. Plus, their inventory levels are fundamentally way healthier than they were a year ago.
Which is huge.
Can you walk us through the mechanics of that? Because I don't think people realize just how dangerous bloated inventory is for an apparel company.
Oh, it's terrible. Inventory bloat is essentially a silent margin killer. When a retail brand manufactures, way too many shoes and can't sell them, those shoes just sit in a warehouse.
And they cost money to store.
Exactly, you're paying for that space. So eventually the company is forced into what we call margin-crushing promotional activity.
Which is just corporate jargon for a massive clearance sale. Right?
Pretty much. You have to slash prices just to get the physical boxes out of the building. But the danger there is when you do that, you train the consumer to never pay full price again.
Right, which completely devalues the brand prestige.
Exactly. So by successfully normalizing their inventory this quarter, management has basically stopped the bleeding. They've protected their pricing power.
Okay, that makes sense.
Yeah.
But we have to address the elephant in the earnings report here.
Yeah.
Because alongside these beats, they announced a $300 million hit for severance and restructuring right now.
Yeah, they did.
And that is a massive, tangible cost. It seems to be exactly what spooked Wall Street so badly.
Well, yeah, because Wall Street tends to view restructuring costs in a total vacuum. I mean, a $300 million severance package means they are cutting a significant amount of corporate overhead.
Right.
It is a painful near-term drag on the balance sheet, undoubtedly, but you have to consider the math of what happens next. By streamlining middle management and reducing payroll today, they permanently lower their operational break-even point for 2027 and beyond.
Oh, I see.
They are becoming a much leaner organization at the exact same moment their primary revenue engine, North American wholesale, is restarting.
So it's like Wall Street is staring at a dented bumper, the $300 million one-time cost, and completely ignoring that the engine was just successfully rebuilt.
That is a perfect way to put it.
But this disconnect leads to a pretty glaring logical question for me. If they beat earnings by 20%, stabilize their inventory, return North America to growth, and are getting leaner, who in their right mind is hitting the sell button so hard that the stock violently craters 9% after hours?
Yeah, it's wild.
I mean, it plunged straight down into the $52 to $54 range. The price action feels completely divorced from the business reality we just outlined.
It is totally divorced from the business, but it makes perfect sense when you understand the mechanics of market exhaustion.
Market exhaustion.
Yeah, that 9% drop pushed the stock to a 9-year low, right? And psychologically, 9 years is an eternity in the stock market.
Yeah.
So picture an investor who has held this stock since 2017. They've watched it soar, they've watched it crash, and they've spent the last 3 years averaging down, just waiting for a turnaround.
Holding out hope.
Right. And then this earnings report comes out. The historical numbers are great, but management issues slightly weak forward guidance for the immediate next quarter.
Just to be conservative.
Exactly. But that investor finally just breaks. They throw their hands up and say, get me out at any price, I'm done. That is the literal definition of a capitulation event.
The towel is officially thrown in.
Yep.
And the volume on that after-hours drop was massive. I mean, the stock was just getting absolutely hammered with sell orders.
But heavy volume on a sharp downward move is often the final stage of a decline. It represents a selling climax. The weak hands, the emotionally exhausted retail investors, the algorithmic momentum traders, they are completely washing out.
Right.
All of that pent-up supply is flushed into the market at once.
Which creates a fascinating setup for the buyers stepping in. But I have to ask the critical question for anyone listening who sees that $52 price tag and is tempted to jump in right now.
Sure.
How do you actually distinguish between a fear gap, like a genuine mispricing driven by panic, and blindly catching a falling knife? Because trying to catch a falling knife in the stock market is a great way to lose a finger.
It absolutely is. You avoid the falling knife by looking strictly for fundamental divergence.
Okay, explain that.
Well, a falling knife happens when a stock drops to a 9-year low and the underlying business is structurally decaying at the same time. Like they are burning through cash reserves, missing their earnings estimates, and just drowning in unsold inventory.
So the business is dying alongside the stock price.
Exactly. If you see that, do not touch it.
But the divergence here is that the price is crashing while the fundamental health is visibly improving.
Precisely. They beat earnings by 20%. The core market is growing again. The inventory is fixed. The fundamental trajectory is pointing up while the stock chart is pointing straight down.
That's the divergence.
Yeah, and that is the hallmark of a fear gap. The selling isn't based on insolvency. It's based on impatience. And that impatience creates an incredible vacuum that smart institutional money will gladly step into.
Well, let's talk about that institutional money because sentiment and market perception dictate where this goes next. We know the immediate reaction was undeniably bearish.
You're right.
But under the surface, who is actually buying those shares from the exhausted retail investor at 52 bucks?
To understand the flow of money here, you really have to look at the rigid mandates that govern large institutional funds. A massive growth fund doesn't just buy what it likes, you know? It operates on strict mathematical rules.
Okay.
If a company's forward guidance falls below a certain percentage of rapid revenue growth, the growth fund manager is legally or structurally mandated to liquidate the position.
Wow, even if they like the turnaround story.
Exactly. Stabilization is not the same thing as rapid expansion. So when management issued cautious guidance for the next quarter, the growth funds were mechanically forced to dump millions of shares.
It's basically a game of financial musical chairs, but with billions of dollars.
Yeah, that's a good way to look at it.
The impatient growth investors are being forced out of the room because the rapid top-line revenue has temporarily slowed down. But that means the deep value institutional investors are quietly sneaking through the back door to grab all the best seats at a massive discount.
That is exactly the rotation happening right now. Value funds do not care about explosive top-line growth next month. They care about calculating the asymmetric risk-to-reward ratio.
Right.
In plain English, that means analyzing how much money you can lose versus how much you can make. At $52, the market is already pricing in a complete failure of the turnaround.
So the downside is essentially capped.
Right. If things stay sluggish, maybe the stock drips down to 48.
Yeah.
But if the sport offense works and margins recover, the stock could run back to 90 or 100.
You are risking a few dollars of downside for massive upside.
And value funds live for that kind of math.
And from an analyst perspective, there's a strategic game being played by management here too. A lot of analysts are viewing this exact moment as the trough of the earnings cycle.
Yes.
Like management intentionally set their forward guidance low for the next quarter.
They are essentially clearing the deck. By lowering the bar now, they make the year-over-year earnings comparisons in the second half of 2026 incredibly easy to beat.
Oh, that's smart. Setting themselves up to deliver positive surprises later this year.
Exactly.
And speaking of the second half of 2026, there is a massive catalyst looming on the horizon that I do not think is properly baked into this $52 price tag at all.
The World Cup.
Yes, the 2026 World Cup is being hosted in North America.
And the timing of that just cannot be overstated. We are talking about the primary apparel outfitter for dozens of national teams.
It's massive.
A World Cup on home soil acts as an incredible retail multiplier. It is a month-long, inescapable global billboard. If their sport offense wholesale strategy is fully operational by then, meaning their product is properly stocked in every Dick's Sporting Goods and local mall across the continent,
Right.
the consumer demand generated by the tournament will act as a massive tailwind for their core North American market.
It really is the perfect storm for a retail resurgence.
Mm-hmm.
But I need to stop the hype train for a second.
Fair enough.
We have a responsibility to be objective here. Before anyone listening buys into this deep value thesis, we have to talk about the actual threats. We need to examine the bear case, because those growth investors didn't just leave the room because of arbitrary mandates.
No, they didn't.
There are real fires burning in this business.
There are, and we cannot ignore them. The most significant structural threat to this entire investment thesis is what industry insiders are calling the China wall.
The China wall.
Yeah. Sales in the Greater China region dropped a staggering 17% this quarter. And we need to be very clear here. This was not a one-off macroeconomic blip. This marks the 6th consecutive quarter of decline in that specific region.
Wait, hold on. 6 consecutive quarters of decline, punctuated by a 17% drop in one of the largest consumer markets on Earth.
Yeah, it's severe.
That isn't a hiccup, that's a hemorrhage.
Yeah.
I mean, if they are structurally bleeding out in a market of over 1 billion people, how do we justify any optimism? Are we just catching a falling knife in Asia while celebrating a dead cat bounce in America?
It is a phenomenal question, and the context of why they are losing revenue there is absolutely vital. The Chinese consumer landscape has fundamentally shifted.
How so?
They are facing incredibly fierce competition from domestic Chinese rivals like Anta and Lining. These local brands have become incredibly sophisticated.
Right, they aren't just cheap knockoffs anymore.
Not at all. They are faster to market, they are highly attuned to local cultural shifts, and they are tapping into a rising wave of nationalistic consumer preference. They are aggressively eating up the market share that, 5 years ago used to belong exclusively to Western legacy brands.
And if you compound that loss of Asian market share with the global margin compression they are fighting, because Gross margins are sitting uncomfortably around 40.6% right now. The picture gets dark quickly.
It does.
I mean, management's own guidance projects a total global sales decline of 2 to 4% next quarter. They're literally telling us they're going to sell less stuff.
They are. The revenue drag is a mathematical reality. But this is where you have to look past the top-line revenue and examine the quality of earnings.
Quality of earnings.
Yeah. Despite that massive 17% revenue drop in China, their actual profitability in the region outpaced analyst forecasts.
Okay, let me make sure I'm hearing that correctly. They sold 17% less physical product to the Chinese market, but they made more profit than Wall Street expected. How does that math actually work on a balance sheet? Are they just firing local staff to save a buck, or is there a sustainable strategy there?
It comes down to something called promotional density, which actually ties right back to our earlier conversation about inventory.
Oh, the clearance sales.
Exactly.
Yeah.
When a brand is desperate to show revenue growth, they will run massive sales. They might sell 3 pairs of shoes at a 40% discount. The top-line revenue looks great, but they actually lost money on the margins.
Right.
What management is doing in China right now is practicing extreme margin discipline. They have drastically reduced their promotional density. They're refusing to chase unprofitable volume just to prop up a chart.
So it's addition by subtraction.
Yeah.
They're saying we will accept a smaller overall market share, but the shoes we do sell will be sold at full price to protect the brand's premium prestige.
Exactly that. Extracting more profit out of fewer sales is a textbook example of operational efficiency. And that discipline is exactly how they plan to survive the revenue drag in China, while the North American wholesale recovery does the heavy lifting for the overall company.
Okay, that makes logical sense. It's about how much cash you actually keep, not just how much gross revenue you process.
Right.
So having weighed the North American turnaround against the very real structural headwinds in China, let's talk timelines. For the listener looking at this setup, what events should they be watching right now to capitalize on this?
Well, we have a very clearly defined catalyst calendar over the next 3 months. In the immediate term, literally over the next few weeks, in April 2026, you need to monitor the SEC filings for Form 4 disclosures.
Form 4. Explain what a Form 4 is and why it matters to the everyday investor.
A Form 4 is a document that corporate insiders like CEOs, board members, executive vice presidents, they are legally required to file it when they buy or sell shares of their own company. Now, insiders might sell stock for a dozen normal reasons, right? Buying a house, paying for college, or covering taxes.
Yeah.
But insiders only ever buy stock with their own cash for one reason. They genuinely believe the price is going to go up.
Yeah, they want to make money.
Exactly. So if we see executives aggressively buying shares at these $52 capitulation levels, it signals massive, undeniable internal confidence that the turnaround is taking hold.
They're literally putting their own personal wolf on the line to back up the corporate strategy.
Yes.
What's the next catalyst after that?
Looking ahead to June 2026, we have the release of the detailed fiscal 2027 outlook. This is the main event.
It's a main event.
Oh, yeah. If management uses that June earnings call to outline a clear mathematical path back to margin expansion, proving that the newly stabilized North American wholesale business is generating cash, the market will rapidly reprice the stock higher. The fear gap will close.
And I guess we also have to keep an eye on the broader macroeconomic picture too, right? We've seen significant tension in the Middle East recently.
Absolutely.
Any geopolitical resolution there could quickly lower global oil prices. It sounds disconnected, but when gas is cheaper at the pump, the everyday global consumer suddenly has more discretionary income in their pocket.
Right, and that extra cash is what gets spent on premium consumer discretionary items, like a $150 pair of footwear.
It all connects.
It really does.
Yeah.
So when you synthesize the fundamental earnings beat, the technical capitulation at 9-year lows, the institutional rotation from growth to value, and the upcoming catalyst calendar, we arrive at our final investment thesis.
The verdict.
Yeah. We are giving this setup a bullish score of 7 out of 10. We have very high conviction on the valuation discount and the North American turnaround, but we are keeping it at a conservative 7 to appropriately weigh those ongoing structural risks in China.
So if you were in an elevator with a listener right now, what is the core pitch?
The pitch is this. The stock is currently priced for absolute failure at $52. But a 20% earnings beat and a return to growth in their biggest market unequivocally prove that stabilization has occurred. This is not a day trade. This is a long-term value play. Your time horizon needs to be 12 to 18 months. You must have the psychological patience to hold through the expected earnings trough of Q4 2026 in order to capture the massive upside potential as the sport offense fully scales into fiscal year 2027.
It is an incredibly compelling setup. I mean, we started this conversation looking at a terrifying 9% after-hour stock drop. But by looking under the hood, we've uncovered a business that is structurally sound.
Exactly.
They are expertly navigating a massive, painful transition away from a flawed, arrogant DTC model and moving back to the wholesale strategy that made them an absolute powerhouse in the first place.
Yes, going back to what works.
And simply because Wall Street mandates demand instant gratification, you are being offered this asset at a 9-year discount.
It is a perfect illustration of why independent critical analysis matters so much more than headline reactions. The market is ruled by emotion in the short term, but generational wealth is built by identifying solid, recovering fundamentals while everyone else in the room is capitulating to fear.
I couldn't agree more. And as we wrap up today's analysis, I wanted to leave you with a final thought to mull over. Something that gets away from the spreadsheets, the technical charts, and the institutional mandates.
Always a good idea.
I want you to think about your own physical closet for a second. Or just look at the shoes you see when you walk down the street today, at the gym, or at the grocery store. How many of those iconic swooshes do you actually spot compared to 5 years ago?
That's a great question.
Has the default choice for the everyday consumer actually changed? Or has Wall Street just temporarily lost its patience with a corporate restructuring? Because sometimes the absolute greatest wealth-building opportunities hide in plain sight right on our feet.
A phenomenal perspective to keep in mind. Apply these frameworks to your own wealth-building journey. Look for the divergence between price and reality and, always keep questioning the dominant narrative.
Thanks for joining us on Smart Wealth with Joshua. We'll be back tomorrow to uncover the next major market catalyst. Until then, invest smart.